Good evening, students. Welcome to the session. I hope a very happy Makar Sankrant, happy Lodi to all of you. So I hope you have revised the appeals topic that we have done. Yes. Any questions so far as regards the appeal dispute resolution topic, which is what we have done? Good evening, Namrata. Yes, students. So today we are going to start with the penalties. Mansha, what is the difference between director and commissioner? So there are different income tax authorities, Mansha. Like for example, in any organization, it's the difference lies in the functions that they perform. They're the functions that they are required to perform. So in any organization, there are different hierarchy you have. Once you qualify as a CA, then you become associate, senior associate, then or executive, senior executive, then you are deputy manager or assistant manager, and then manager, then deputy director, then director, like that. So there are difference in the functions and the roles and responsibilities that one perform. That's the major difference between the director versus commissioner of income tax. Yes, any other question? Yes, good evening, Viraj. Yes, so okay, let's get started with the penalties topic then. I hope you have revised the assessment and the appeals and you have understood that really well. So today we are going to discuss about the appeals topic, okay? So let's get started with it. So you can just write down the new topic over here. Penalties. Penalties and prosecution. So here we are looking around the topic from your module, which is the provisions to counteract unethical tax practices and miscellaneous provision. These are the two topics which you would find in your module covering the penalties and prosecution. And of course, the black money law, which is what we'll be doing once you finish off your transfer pricing classes day after. And then once again, I join back. So we'll start with the black money law at that point in time. So after your transfer pricing classes, we will have the black money law. Today, we are going to restrict to the penalties and prosecution. Okay. So let's get started, student. So see, again, going back to the stage of the assessment, students, right? What we started discussing with was, see, I told you, you have to file your return of income, right? You can file your return of income under 139.1 or 139.4, which is a belated 139.5, which is a belated return, right? Or 139.8A, which is an updated return, right? And then there would be 143.1 summary assessment or the processing of the return, which will be done. Then you have the normal scrutiny assessments, which start with the show cause notice under 143.2 and ends with 144 notice. 144 order best judgment assessment in case you do not respond, do not provide information, or 143.3 order, right? There could be a reassessment under 147, which ends with the order under 147 read with 143.3 read with 147, right? Now, in all these assessment orders, either there could be the reduction of the losses that you might have claimed. So in case your return was a loss return, the income tax officer would make the additions to the total income, and there could be the reduction of loss, right? Disallowance of the loss that you would have claimed. Or it could be conversion of loss to the income. You might have claimed loss. Now it might be getting converted to the income after making the additions. Or it could be the enhancement of the income. These are the three possibilities that you could see in the assessment order, right? Now, once the assessment order passes, then from there, you will also have the initiation of the penalty. So after your assessment proceedings, where the assessment proceedings would end, your penalty proceedings would start. So from that point, there would be the initiation of the penalty. There would be the initiation of the penalty. So let me just write it over here. In the assessment procedure itself, where we had drawn that scale of assessment procedure, how the assessment procedure takes place, this one, right? There, we had ended with the notice of demand under 156. After this, there will be you can write down initiation of penalty. Initiation of the penalty proceedings. Now there are different kinds of penalties for different kinds of issues that may arise in your assessment or the different defaults that you might have made. So, time and again, we have already covered most of the penalties wherein we were discussing about those topics. Right? So, we have already covered most of the penalties. You will now find it. Once I will start discussing about that. But any which ways, nevertheless, we will continue to discuss the rest of the penalties over here and we'll just correlate what we have already discussed so far. So this is what we are going to deal in the penalties and prosecution. So initiation of penalty. So see what happens, student, is that once you get the assessment order, students, once you get the assessment order, then along with that, you also get a penalty notice. You also get a penalty notice. And there could be penalty levied under different sections. So again, for penalty, how the penalty proceedings start? It again starts with the show cause notice. It starts with the show cause notice. Are we getting that? So let's say, for example, I'll show you one of the penalty notice that we have here. See, notice under section 274 read with section 271(1)(b) of the Income Tax Act, non-compliance to notice under 142(1). And they have issued this show cause notice over here. Similarly, as I said, for different kinds of different kinds of defaults, there could be different penalty notices which could be issued. For example, I'll show you one more over here. See, notice for penalty under 274 read with 271(b), where in the course of the proceedings before me, it appears to me that you have failed to get accounts audited or failed to furnish a report of audit as required under 44AB. You are required to show cause why an order imposing penalty under 271(b) should not be passed. Now, if you can see, this is entirely coming through the NFAC. So even the penalty proceedings have become completely faceless, like the assessment and the appeal procedures. Even the penalty proceedings are done in a faceless manner. It will come through the NFAC along with the assessment order. So along with the assessment order, you will get the notice of demand. And along with the notice of demand under 156, there will be the initiation of penalty, which will start with the show cause notice, students. So this is how the penalty proceedings start. So just write down. Let's write down over here. penalty proceedings. Fine, students, penalty proceedings. Good evening, Mohammed. So how does it start, students, penalty proceeding? It starts with, again, the show cause notice, students. So section 274, it starts with the notice, or you can just write down show cause notice under section 274. Show cause notice under 274 as to why the penalty should not be levied. Are we clear? Secondly, under the show cause notice under 274, who can initiate the penalty? So, the penalty order can be passed by either the income tax officer if the quantum of penalty is more than 10,000, and by the ACIT or DCIT if the quantum of penalty is more than 20,000. And this will be entirely in the faceless scheme. Yes, even the CIT appeals operates in a faceless manner. ITAT is not faceless. ITAT, High Court, Supreme Court is not yet faceless. CIT appeal is faceless. Fine. Okay, so it starts with this. The notice under 274. Are we clear? Okay. Now, what are the different penalties that we are going to see? So the first penalty that we are going to see is the penalty on underreporting or misreporting of income, students. Penalty on underreporting and misreporting of income. So just write down. Penalty on underreporting or misreporting of income. Penalty on underreporting or misreporting of income. This is under section 270A. This is under section 270A. So section 270A, yes, the lead jurisdiction of AO CIT appeal is based on the automated process. Of course, you have a jurisdictional AO which is confined to certain powers for which the faceless assessment does not exist. So that jurisdictional AO still exists, but for assessment, it will be through an automated process. And similarly for the CIT appeals as well. Yes, Dilip, you're right. So yes, you can write down even in the case of CIT appeal, you can just mention over here where we had done the appeals and revision. That this is entirely faceless. Yes, we have written over here. It's a faceless appeal mechanism. We have already written. Fine. Okay, so section 270A provides for the penalty on underreporting or misreporting. Yes, Mansha, underreporting is an offense and results in penalty. Now, what is underreporting of income? So 270A provides for the underreporting of income. A person shall be considered to have underreported. A person shall be considered to have underreported his income my A is greater than B. If my A is greater than B. Are we clear? Now what is A and what is B? So just write down. If the return of income is filed, if the ROI is filed, then if my income assessed, if my income assessed is greater than the income determined, if my income assessed is greater than income determined in the ROI processed under section 143(1)(a). So basically, my income tax return, if it has been filed, and if my income assessed in the scrutiny assessment, this is the income assessed under section 143(3) or 144. If the income assessed is greater than the income determined in the return processed under 143(1)(a). Now, income determined in the return process, they are saying. They are not saying income determined in the return of income file. Meaning, the adjustment, the arithmetical adjustments or incorrect claims which are adjusted in the return of income which is processed under 143(1)(a), that income you need to consider and not the income that you have filed in your return of income. The income that you have reported in the return of income, that is not to be considered in B. The income which is after considering the adjustments under 143(1), that income you need to consider. So there is no underreporting of income in case there is inconsistency between the income reported and that which is processed under 143(1)(a). Because those are arithmetical error. There is no concealment of income. There is no underreporting of income under 143(1)(a). That is just a processing which is happening. So the arithmetical inaccuracies or any incorrect claims which are apparent, those are adjusted. That cannot be considered as underreporting of income. So any discrepancy between the income reported and that which is processed under summary assessment, that is not considered for underreporting. So the income which is processed under summary assessment, you compare with that, what is your assessed income under the assessment order. The difference between that is considered to be the underreporting of income. Are we clear? Yes, Namrata, always if you're reporting the excess income, then why somebody would have problem? It's only when you're reporting excess losses or you're underreporting the income, then only the income tax authorities would have obviously the problem. Right? So that is number one. Second, the return of income is not filed, where ROI is not filed or furnished, or the ROI is furnished in response to notice under section 148. So the ROI is not filed, or the ROI is not filed, and therefore when 148 was issued to you, at that time you are filing the ROI. In that particular case, what will be my underreported income? In that particular case, what will be my underreported income? So, in that case, they say that the underreported income means you would be said to have underreported the income if the income assessed in your assessment order is greater than the basic exemption limit. Is greater than the basic exemption limit. Yes, Mansha, updated return can also be considered over here. Okay. So if the ROI is not filed, if the income assessed is greater than the basic exemption limit, then you would be considered to have underreported the income. Then you would have been considered to have underreported the income. Are we clear? So if you have filed the ROI, then income assessed, if it is greater than the income processed under 143(1)(a), which is the summary assessment. Are we clear? And in case the return of income is not filed or filed in response to the notice issued under 148, then in that particular case, it will be the income assessed if it is greater than the basic exemption limit. Are we clear? Now, how the 148 notices are there? It's not 148A notice, students. If you remember, I told you 148A is a show cause notice which is issued, which asks the assessee as to why the reassessment should not be made on that assessee. And once the 148A order is passed with the approval of the specified authority as to whether the reassessment should be initiated or not, then the notice under 148 is issued asking the assessee to file the return of income, students. Are you getting that particular point? So it is if you're filing even a return in response to 148, then in that case you have to have underreported the income when your income assessed is greater than basic exemption limit. Why? Because you have not initially filed the return. And now you're filing in response to 148. So you have not filed the return under 139. If you have filed the return under 139 and again you are filing in response to 148, then this will not be the case. Then you will fall under case 1. So return of income is furnished. You can write here for first time in response to notice under 148. If you're filing your return for first time under 148, then only you will fall under the second clause, students. Otherwise, you will not fall under the second clause. Are we clear, students? Yes or no? Any questions? Any doubt? Yes? Yes, students. Any questions till now? Did you understand this particular point? Okay? Yes. Now, the return under 148, I'll just show you that as well, how the notice under 148 and 148A appears. So just look at it. See, I have the following information in case of the person in respect of which you are assessable under the Income Tax Act for the assessment year 18-19. Information flagged by the risk management strategy. See, this is what we were talking about, right? Information flagged by the risk management strategy, which suggests that the AO has the information that the income chargeable to tax has escaped assessment within the meaning of section 147 and the order under 148AD has been passed. I therefore propose to assess or reassess such income or recompute the loss or the depreciation allowance or any other allowance or deduction for AY 18-19, and I hereby require you to furnish within 30 days from the service of the notice a return in the prescribed form of AY 18-19. And this notice is being issued after obtaining the prior approval of the Commissioner of Income Tax. Are we getting this? So remember, this is what I told you. That first, there will be the notice issued under 148A, a show cause notice under 148A. Then there will be the order which will be passed under 148AD. And then there will be the notice under 148 to require you to file the return of income. Are we clear? And that has to be with the approval of the specified authority. The specified authority is PCIT, PDIT, CIT or DIT if it is 3 years from the relevant assessment year. Here we are looking at assessment year 18-19. So this was issued in 2022. So this was within the 3 years and therefore the relevant authority, specified authority here was Commissioner of Income Tax. Are we getting? Yes or no? Yes? Okay. Now I'll also show you. Namrata, for the first time as in, I told you the meaning of the for the first time as in that you have not filed the return of income under 139. And you're filing it for the first time in response to notice under 148. Then you will fall under case 2. Case 2 meaning you will be said to have underreported the income if your total income is assessed is more than the basic exemption limit. If you have already filed the return under 139 and you are again refiling under 148, then in that case you will fall under case 1 because you have already filed the return, you are not filing it for the first time under 148. Clear, Namrata? If you are filing for the first time under 148, you will file under, your income will be said to be underreported under case 2. Namrata, the basic exemption limit logic is that, see, below the basic exemption limit, you are not required to file the return of income. Only in the exceptional cases that when your expenditure is more than electricity expenditure more than rupees 2 lakh, forex expenditure more than 2 lakh, deposit in the current account more than rupees 1 CR, right? Only on those specified cases or if you are a beneficial owner of any asset outside India. Or you are a beneficiary of a foreign asset, financial interest in an entity outside India, right? In those exceptional cases, you are required to file the return of income even if your total income may be less than the basic exemption limit. Are we clear? Otherwise, you are not required to. Or if your total receipts, gross receipts are more than 10 lakh, total turnover is more than 60 lakh, TDS more than 25,000 or 50,000, right? Otherwise, you're not required to file the return of income if your income does not exceed basic exemption limit. So only if your income exceeds basic exemption limit means you have not filed the return of income and therefore you have underreported the income. Are we clear? Yes? Yes, I'll also show you how 148 show cause notice is passed. I can show you that as well. See. Whereas I have the information which suggests that the income chargeable to tax has escaped assessment within 147. The details of the information and inquiry are enclosed in the annexure. You are required to show cause as to why, in view of the details contained in annexure A notice under 148 should not be issued. And this notice is issued after obtaining the prior approval of CIT. So, this is not under faceless. If you see here, this is not under faceless. So, notice faceless assessment will start with the notice under 143.2. Prior to that, the notices under 148 are not under faceless assessment. Are we clear? Similarly, if you look at the order under 148A, I'll show you that as well. The order under 148A. See, these are the orders under 148A. So, he has passed a very detailed order and then they have said, in case the no return has been filed, further the requirements to initiate proceedings as provided in the 148A have been duly followed with the prior approval of specified authority. And in view of the above, provisions of 147 are applicable where the income chargeable to tax has escaped assessment. Therefore, this is a fit case to issue notice under 148. And after that, the notice under 148 is issued. Clear? Are we clear? Yes or no? So this is how the notice under 148 requires you to file the return of income. Even if you would have already filed the return of income under 139, 148, again ask you to file a return of income. Namrata, you cannot get this notice for your reference because these are actual notices issued to the assessees. Okay? Yes, students. So just now, let's proceed with the penalties again. Then the third case that we are talking about is, one second. When can you set to have underreported the income? In the case of the reassessment, in case it is, the third case is the reassessment. In case of the reassessment, when can we say that the person has underreported the income? If the income reassessed, if the income reassessed is greater than the income assessed before such reassessment. So basically, income reassessed in order under 143, 3 read with 147. If it is greater than the income assessed in the original scrutiny assessments in the order passed under 143.3. Are we clear? Then fourth, return of income has been filed. Return of income has been filed and assessment or the reassessment, assessment or reassessment is made on the basis of MAT or the AMT. MAT or AMT provisions. So in that case, again, it's going to be the same thing. The amount of deemed income, the deemed income, deemed total income you can write, deemed total income assessed or reassessed if it is greater than deemed total income determined in the ROI processed under section 143(1)(a). Deemed total income assessed or reassessed, it's the same thing. Normal income also, if the return is filed, it will be normal income. If it is deemed total income under MAT or AMT, so that will be considered if it is greater than the income determined in the ROI processed under 143(1)(a). Then if no return of income is filed, or ROI is filed for the first time under 148, and assessment or the reassessment, and the assessment or reassessment is based on MAT or AMT provisions. Again, it's going to be the same thing. Deemed total income assessed, deemed total income assessed is greater than the basic exemption limit. Is greater than the basic exemption limit. Are we clear? And last one, reassessment as per reassessment of deemed total income as per section, or you can just write deemed total income on the basis of MAT or AMT provision. So it's again the same thing. Deemed total income reassessed if it is greater than the deemed total income assessed before such reassessment. Before such reassessment. So in these cases, one can say that you have underreported the income. Okay? Yes or no? Any questions? Any doubts, students? Namrata, differentiate between 148A notice and order after that. So, Namrata, the 148A notice is a show cause notice asking you, the income tax officer has the information of which he has made the inquiry. That information was in accordance with risk management strategy. Risk management strategy meaning the information collected through the SFTs, through the reporting entities, SFTs file or audit information, or based on the information collected under 133, 133B, 133C, 134, right? Search or survey, where it can be a deemed information, right? Or the information which is in pursuance of an order passed. So in those cases, the income tax officer has the information on which he would inquire, and if that information suggests that the income chargeable to tax has escaped assessment, then except in the case of the information which is collected by the income tax officer under 133, 133B, 134, or the information which is under the search, except in those cases, the income tax officer will give you the opportunity of being heard as to why the reassessment should not be made. And that opportunity will be given by issuing a show cause notice, show cause as to why the reassessment under 147 should not be made. Show cause as to why the notice under 148 should not be issued on you. And that show cause notice is issued through 148A. And based on the replies of the assessee and the material available with the income tax officer, he would decide as to whether he should drop the reassessment proceedings if he is satisfied with the reply of the assessee, or whether he should proceed with the reassessment. And that he will issue by passing an order under 148A that the reassessment should be done. Clear, Namrata? Dilip, assessed means the assessment order is passed. Obviously, you can assess once the assessment order is passed. You cannot assess only on the basis of assessment initiated. Point number 6, Namrata, what is point number 6? The deemed total income reassessed under 147 compared to the deemed total income assessed in the original scrutiny assessments. So deemed total income reassessed under 147 when the reassessment is done compared to the deemed total income which was there in the original assessment proceedings. Yes, Namrata, is it clear? Yes, students. So in these cases, if the A is greater than B, it will be deemed that you have underreported the income. Seventh case, if the loss is reduced or loss is converted to income, reduction of loss or converting the loss to income will be considered as the underreporting of income. Will be considered to be underreporting of income. Now, what is my underreported income? We understood, ma'am, that yes, in these cases, if my A is greater than B, I will be considered to have underreported income. Yes, Namrata, if you have paid the excess tax, then you get the refund back with the refund order passed under 237, under section 237 of the Act. Are we clear? Okay. So now, yes, you have underreported the income if your A is greater than B. But then in that case, how do we calculate the underreported income? So that is also very simple. So just write down, make one more column next to this. Calculation of underreported income. Calculation of underreported income. So where the return is furnished and the assessment is made for the first time. Where the return is furnished and the assessment has been made for the first time, which is the first case that we are talking about. In that particular case, my underreported income will be assessed income minus income determined under section 143(1)(a). So which is A minus B, students, where the return of income is filed and income is assessed under 143(3), 144 or even under 147 or even under 147, right? So this is income assessed for first time. So then in that particular case, the A minus B is the underreported income. Assessed income under 143(3), 144, 143(3), read with 147 minus the income determined under 143(1). Clear? Second situation, where the return is not furnished or is furnished for the first time in response to 148th notice and the assessment is made for the first time. Then what is A greater than B? A is the income which is assessed and B is the basic exemption limit. Now, students understand, the basic exemption limit is not going to be applicable in the case of company, firm, LLP. The basic exemption limit is going to be only applicable for individual, HUF, AOP, BOI, right? So therefore, A minus B will be for the company, it will be the assessed income because there is no basic exemption limit for the company or even, for the firm. So company, firm or the local authority. It will be just the assessed income. And for others, it will be assessed income minus the basic exemption limit. Assessed income minus the basic exemption limit. Third scenario, where the income is not assessed for the first time. Are we getting that? Where the income is not assessed for the first time, where it is a case of reassessment. Then what is my A? Income reassessed minus the income assessed in the original assessment. Are we clear? So this is going to be my underreported income. So therefore, in the third scenario, if you want, you can just make it little simpler. Income assessed before such reassessment, you can just instead write income assessed under original assessment. Clear? So then in that particular case, it will be income reassessed minus income assessed under original assessment. Okay, so this is how the A minus B will be considered, which will be your underreported income. Then where the underreported income arises out of the determination of deemed total income as per the MAT or AMT. Then in these cases, it will be A minus B plus C minus D. A minus B plus C minus D. Now, what is this A minus B plus C minus D? Now, this is in all these cases where the income is determined under MAT or AMT. So, where the underreported income arises out of the deemed total income as per MAT or AMT. So, in that case, my A will be total income as per normal provisions. Total income as per the normal provisions. B will be the total income excluding the underreported income. Excluding the underreported income as per the normal provisions. C will be deemed total income as per 115JB or 115JC. So, as per MAT or AMT. And my D will be deemed total income excluding the underreported income as per MAT or the AMT. Are we clear? And the last case where the where the loss is reduced or converted into income. So in that case, the loss claimed minus the income or the loss assessed or reassessed. Income or loss, assessed or reassessed. Yes, students, any question till now? Yes, Mansha, senior citizen here can enjoy higher exemption. Whatever is your basic exemption limit, new scheme, old scheme, whatever it is. Yes or no, students? Any question? Did you understand when can we say the person has underreported the income and what is underreported income? Are we clear? Yes or no, students? Faster. Yes? Okay. Now, who is the authority who is empowered to initiate this particular levy? So, who is the authority who is empowered to initiate the 270A? So, the authorities who are empowered to initiate 270A is the assessing officer, JCIT appeals, CIT appeals, PCIT, or the CIT. So, if you see at the assessment stage, the penalty can be levied. Even at the stage of appeals, I had told you at the time of CIT appeal, a CIT appeal can enhance, reduce, modify the appeal. He can also initiate the penalty. So if you remember over here, while we were discussing with the powers of the CITA, confirm, enhance, reduce or cancel the penalty plus the levy the penalty if not levied by the AO. So even CITA has the power to initiate the penalties under section 270. So you can just write down over here, authorities empowered to levy penalty under section 270A. It is AO, CITA, JCIT appeals, PCIT or the CIT. Are we clear? Okay. Namrata, A plus B plus C minus D is not clear. I'll explain. The meaning of underreported and misreporting. Yes, Dilip, I'll explain that as well. So A minus B. So basically see Namrata. This is the total income as per the normal provision. In the A, you will consider the total income including the underreporting income. B, you will consider the total income excluding the underreported income, meaning A minus B is nothing but your underreported income as per normal provision. Whereas C minus D is your underreported income as per MAT or AAT. So C is deemed total income including the underreported income as per MAT, and D is the total income excluding the underreported income. Are we clear? Yes or no, students? Okay. So this is the calculation of the underreported income. And then we have the cases of misreporting of income. Now, what is misreporting of income? Misreporting of income. Misrepresentation or suppression of facts. If I misrepresent or suppress the fact, misrepresentation or suppression of facts. So basically, let's say, for example, if I try to evade the taxes, there is a difference between tax avoidance and tax evasion. If I, let's say, for example, I have not paid the premium for LIC and I have just given the fake information in my return. There are a lot of salaried clients. They will come to you and say, sir, ma'am, please reduce our taxes. We are paying so much of taxes. You are a chartered accountant or you are studying the chartered accountancy course. You would have some sort of way out to reduce my taxes. And you'll tell them, sir, legally it is not possible. You have not paid LIC. You have not paid medical premium. You have not paid interest on housing loan. How do we reduce it? He will come to you and say, okay, you put the fake claims. That is the misrepresentation or suppression of facts. Or at the time of assessment, let's say, for example, you produce the fake invoices. You give the false evidences. You give the false statements. Income tax officers ask you whether you have purchased the goods from so and so person. Will say yes. He's examining you on oath under 131. And you're giving the false statement. You're suppressing the facts. Even when you have not purchased, it's a hawala transaction. So misrepresentation or suppression of facts is not underreporting, it is misreporting of income, students. Second, failure to record investments in the books of accounts. So basically, you have made the investments, let's say in a house property, or you have made the investments in stock market, you have made the investment in several companies, in partnerships. You are earning the income, but you have not recorded the investment at all. So you are not disclosing the income from that investment also. That is misreporting of income. Third, claim of expense not substantiated by evidence. So basically, you have, let's say, for example, made the purchase. And let's say you do a black to white. You make the purchase of, let's say, rupees 1 CR. And you pay the commission to the other party, let's say 2% of 1 CR, and get the amount back in cash. So you have recorded the expenditure. You are showing the invoice, but there is no stock of goods with you. It's just doing black to white. Are you getting this particular point? So claim of expenditure not substantiated by any evidence, or you show, I have provided these services to my related party. You are not able to prove that you have rendered these services. There is no benefit obtained to the other party. Then it is a case of misreporting of income. Fourth, recording of false entry in the books of accounts. You are recording some false entry, recording something, expenditure, fake expenses, fake entries you are putting in the books of accounts. So that is misreporting or failure to record any receipt in the books of accounts, which is having bearing on total income. So you are not recording any receipts in the books of accounts. That is again misreporting of income. And the last one, failure to report any international transaction or deemed international transaction. Now, what is international transaction and deemed international transaction? You will learn in transfer pricing. Or the specified domestic transaction under chapter 10, which is transfer pricing. You will learn that in the next class. I know, Namrita, that really happens with all of us. Yes, fake interest charges, loan, everything. So anything fake claims that you're making, where you're trying to evade the taxes. See, as I told you, there's a difference between avoiding the tax and evading the tax. Avoiding the tax means you're trying to take the benefit of the loopholes under the law. You're trying to interpret the provision of the law in your favor. On that is not considered as misreporting. That may fall under underreporting. But when you are trying to evade the taxes, you are circumventing the law itself by doing the fake things. Then it is a misreporting of income, students. Now, what are the consequences of underreporting and what are the consequences of misreporting, students? So in case of the underreporting, students, the penalty is on underreporting. So on underreporting of income, the penalty is, students, 50% of tax on underreported income. It's not 50% of underreported income, it's 50% of tax on underreported income. And in the case of misreporting of income, where the underreporting results from misreporting of income, it is 200% of tax payable on the underreported income. Are we clear, students? Yes or no? Namrita, you will understand why the specified domestic transactions and not all the transactions, because these specified domestic transactions are covered under transfer pricing. International, deemed international, specified domestic transactions, these are covered or defined under the transfer pricing. So where you do not report these transactions, you will have penalty under 270E. Are we clear? Yes, Namrita. Okay. So that is under the transfer pricing. You will learn that in the next class. Okay. Yes or no? Yes, students. Okay. Any questions? Any doubt? Now, what is the tax on the underreported income? What is the tax on the underreported income? How will you calculate the tax on the underreported income? So basically, let's say for example, where the total income is determined in case where no return of income has been furnished earlier, or where the return of income is furnished for the first time under 148, then the tax on the underreported income will be the tax on the underreported income that you have calculated, which is A minus B. Are we clear? So just write down over here. Okay, so just write down the tax on underreported income. This is what we have calculated, the underreported income. You can just write down. tax on underreported. So how will we calculate the tax on the underreported income, students? As I told you, in the case of the tax on underreported income, it is the tax on the A minus B which is there. So this is the tax on this underreported income which is coming. Right? In the first case, this will be tax on the underreported income which is coming. In the second situation, where the return of income has been furnished, has not been furnished, or the return of income has been furnished for the first time under 148, then it will be tax on the underreported income it shall be the tax on the underreported income plus the basic exemption limit. Plus the basic exemption limit. Underreported income plus the basic exemption limit. Yes. Then in the case where the total income is determined, under 143(1)(a), which is a loss, in the case of the loss, how would you calculate the tax? Because even in the case of the loss, if the loss has been reduced or if the loss is converted to an income, then also there is underreporting. So how will you calculate the tax in the case of a loss? So in that case, the tax of the underreported income shall be the amount of tax on that loss as if it was a total income. So in the case of the loss, you can just write down tax on the loss as if it is the total income. As if it is the total income. Third thing, in any other case, whether you have the assessment, whether it's a case of reassessment where you have filed the return, or whether it is the case of the MAT or AMT. In that case, the tax will be on the underreported income. Are we clear? Tax on the underreported income. So in all these cases, in rest of the cases, it shall be tax on underreported income. So only in the case where you have not filed a return or filed in response to 148 for the first time, it will be tax on underreported income plus basic exemption limit. In case of loss, it will be tax on the loss as if it was an income. Any questions, students? We are going to solve a few questions around that so that you will understand it in greater detail. Yes, clubbing provision, how much it will result in the underreporting? I don't understand. Namrata, as I said, misrepresentation means that misreporting of income means where you are doing the fake claims, fake expenses, suppression of facts, you are not submitting the invoices, you are claiming the fake expenses, you are not reporting the receipts, those are misreporting. Underreporting where A is greater than B. Clear? Any other question? Any other doubt? Yes, students? Yes or no? Yes or no? Any questions, students? Okay. Okay. So let's proceed further then in that particular case. So now understand one thing. This is how the tax has to be calculated. Now let's solve few questions around this before we go on to the break to understand how exactly this particular underreporting of penalty on underreported income is calculated. I'll give you the questions. You are required to solve that and give it to me, the answers, and then we can proceed further. I'm just putting the questions from your module itself. XYZ is a firm liable to tax at the rate of 30%. Following are the particulars. As per the return of income furnished, 139.1, this is the total income. Then determined under 143.1A, assessed under 143.3, reassessed under 147. Compute the penalty. Yes, very simple question. It's a very, very simple question, students. Yes, students, please calculate. So first is when the income is assessed under 143.3 students. Now the income assessed under 143.3 students is greater than the income which is determined under 143.1A. Right? So this is going to result in the underreporting of income. Now, if this is underreporting of income, what is the underreported income, students? Underreported income is the difference between the two. This is going to be 15 lakhs. And the tax on the underreported students' income. The tax on the underreported income. What will be the tax on the underreported income, students? Calculate for me. Yes. The tax on the underreported income is going to be 30% of this amount, which is going to be 15 lakhs into 30%, and the cess of 4%. Right? 4,68,000. So the tax is 4,36,000. And the penalty on that is 50%. Right? The penalty on this will be 50%, which comes to 2,30,000. 34,000. Is that clear, students? Yes, the first point is clear. 15 lakh, yes, Mansha, you are correct. Dilip, no. Penalty is 2,34,000 students. Yes or no? Is it clear? What is in the second case? What's the answer in the second case? Okay. What's the answer in the second case, students? Namrata, I've written the calculation here. It is 15 lakh is the underreported income. Tax on underreported income is 4 lakh 36,000, 30% on under 15 lakh plus cess of 4%. You have forgotten to add the cess of 4%. Obviously, there will be cess of 4%, right? And the penalty is 50% on that. What will be the answer in the second case, students? Very simple question. Yes, students, it's very, very simple. Faster. Yes, Namrita, correct. In the second case, yes, Mansha, underreported income is 20 lakhs. So in the second case, my underreported income is 20 lakhs. Tax on underreported income is, students, 30 into 4%, 30 plus 4%, right? Which is coming to 6 lakh 24,000, and penalty at the rate of 50% comes to 3 lakh 12,000. Yes, Dilip, very good. We have to write that we are assuming that this is underreporting, not on account of misreporting. We have to assume that. Yes, you're correct. Clear? The next question, I am putting it out. This was very simple one. Another one is also very simpler, but just let's write down. Mr. Ram, a resident individual of 55 years, has not furnished his return of income. However, the total income assessed in respect of such year under 144. 144, why? Because it could be the best judgment assessment. Remember, I told you the best judgment assessment can be made when the return of income is not filed. Right? And is rupees 12 lakh is penalty attracted in this case, and what is the quantum of penalty? So just calculate for me. Yes, underreported income. That is correct. Namrata. And what will be the tax? Students, in this case, the underreported income will be what? Here, the return of income is not filed, right? So, underreported income here will be my total income minus the basic exemption limit. Total income assessed, right? Which is 12 lakhs minus 2.5 lakh. So, underreported income is 9.5 lakh. Now, what is going to be my tax on underreported income, students? What is going to be the tax on underreported income? Assuming you are not, you have to write in the examination that it is assumed that you are not opting out of the 115 BAC default regime. Or you have to write it is assumed that you are opting out of the default tax regime. In case nothing is given the question, it's safer to assume that you are not opting out of the 115 BAC default tax regime. Viraj, once the assessment is done, why the reassessment can happen? Because the income could have escaped assessment in the earlier assessment. In the earlier assessment, it's quite possible that the income did not, or that particular issue did not come to the notice of the income tax officer. So reassessment can happen. But of course, the assessing officer cannot do the reassessment in the garb of changing his opinion. It is possible that the income tax officer initially thought this income should not be taxed. So he leaves that. He examines everything and he leaves that. He said, okay, this is not taxable. And then 2 years down the line, he realizes, no, I should have taxed that income. So he cannot do reassessment in that case because that is a change of opinion. Change of opinion is not permissible under reassessment. It is only when that he has that even after the examination of the entire case of the assessee, that particular issue does not come to the notice of the income tax officer because the assessee has not disclosed the facts at that point in time. So then in that case, if the normal assessment has happened, in that case, the reassessment can also happen, Viraj. No, Namrata, the tax is not correct. Mansha, yes, the tax is 93,600. So up to 3 lakh, nil, assumed that the assessee has not opted out of default tax regime under section 115 BAC. So up to rupees 3 lakh. Sorry, here I have made a mistake. It's not 2.5 lakh. This should be 3 lakh. This should be 3 lakh. And therefore the underreported income, sorry, it's not 9.5 lakh. It is 9 lakhs. So it is assumed that the assessee has not opted out of the default tax regime. So up to 3 lakh, nil. Then 3 lakh to 6 lakh, it is 5%. So 15,000. Then 6 lakh to 9 lakh, again it is 5%. So, sorry, it is 10%, not 5%. This is 10%. So 30,000, right? And then 9 lakh to 12 lakh. It is 15%. So as I said, tax on the underreported income here plus the basic exemption limit has to be considered. Right? We discussed that just now. We said that in case no return of income has been filed, then it will be tax on underreported income plus basic exemption limit. So here you will not consider tax on 9 lakh. Here you will consider tax on 12 lakh. Right? So in this case, this will be 45,000. So this will be 45 plus 30 plus 15,000, 90,000, and then cess of 4%, which gives me 93,600, which gives me 93,600 students, and penalty at the rate of 50%, it will be 46,800 students. Yes, are we clear? Mansha, you have corrected, you have computed properly. Why did you revise your answer? No, Namrita, you cannot assume misreporting instead of underreporting unnecessarily, unless the facts demonstrate like that. Delete. The other possibility of reassessment is that the assessment has not happened at all. The assessment has not happened at all. So if the assessment has not happened, there could obviously be reassessment. Because the original assessment timeline has passed, which is 3 months from the end of the financial year in which return is filed. So obviously the income tax officer can reassess. Okay? Yes. Next one. Now third case we are examining is the loss situation. ABC is a domestic company liable to tax at the rate of 25%. Following are the particulars furnished as per the return of income furnished 115 lakh. Determined under 143(1)(a) 8 lakh. Assessed under 143(3) 5 lakh. Reassessed under 147 4 lakh. Compute the penalty. Yes, students. Yes, faster. Yes, correct. You're right, Namrita. Penalty is 39,000. Very good. So basically, in the first case, if you look at my loss has reduced. So this is the case of reduction of the loss. So what is my underreported income over here? The loss assessed earlier, loss assessed now, sorry, which is 5 lakh minus the loss assessed earlier. So this is going to be, students, minus 5 lakh minus 8 lakh. So minus plus normal arithmetics, right? So 5 lakh minus 5 lakh plus 8 lakh, which is going to be 3 lakh. So my underreported income is 3 lakh. My underreported income is 3 lakh, and then the tax on this is tax at the rate of 25% plus the cess of 4%. Right? So then in that case, it is 3 lakh into 25% plus 4% comes to 78,000. And penalty at the rate of 50% is 39,800. Sorry, 39,000, not 39,800. It shall be 39,000 exact. Fine, students? In the next case, my loss is converted to income. So in the next case, my loss is converted to the income. So my underreported income shall be 4 lakh minus 5 lakh. 4 lakh minus 5 lakhs. Yes, Mancha, you are right. So it will be how much? 9 lakhs. Yes, Namrata, you are correct. So this will be 9 lakh. And then the tax at the rate of 25% plus 4% on 9 lakh is going to be 2,34,000. And penalty at the rate of 50% will be 1,17,000. Yes, Mansha, correct. Very good. All the students, is it clear? Yes or no? Is the penalty topic clear under 270A? Yes? Perfect, Viraj. Everybody respond to me before we go on to the break. Is this clear? Penalty under 270A, Mohammed, very good. Perfect, Namrata. Yes, perfect, Dilip. Yes, Dilip and Viraj, I'll give you the note on reassessment after the break. Let's take a break of 10 minutes. We then get back and then we will start with the rest of the penalties. Now, rest of the penalties are not complex, student. This was one of the complicated penalty. Okay. Of course, we are still left with 1 or 2 points on this penalty as to when the penalty cannot be levied, but we are majorly done with this major penalty. Rest of it are not that complicated. Okay. So let's take a break of 10 minutes, students, and then we get back. Notes would be uploaded for sure. Mansha, the clubbing is legal or illegal? It's not illegal, Mansha. See, clubbing is the anti-tax avoidance provision. It is not tax evasion. Tax evasion is illegal. When you make the fake claims, when you submit the false entries in the books of accounts, that is something illegal. That is tax evasion, Mansha. See, there's a huge difference between tax avoidance, tax planning, and tax evasion. Tax planning meaning what? Let's say, for example, I have the income, right? And I want to reduce my tax liability as much as possible, Mancha. So what I will do, I will look out for the options that the tax law is giving me to reduce my tax liability. And what are the options, Mancha? I can put it in LIC. I can invest in the tax saving fixed deposit. I can purchase the house property. If I have a capital gain, I can reinvest the amount in another residential house property to save the capital gains. These are the options which are given by the tax law itself. That is tax planning. That is very much within the four corners of the law and is very much legal and permissible because the tax law is allowing you to reduce your tax liability by planning it in a purposeful manner. Then comes the tax evasion. Tax evasion is completely illegal. So tax planning is one end of the line and tax evasion is another end of the line. When you submit the fake receipts, you do not disclose your income, you try to hide your income, you try to claim the fake expenses, you try to misrepresent the income tax officer, you try to camouflage the transactions, whatever I have written over here in the misreporting of income. So these are the cases of tax evasion. You do not record the assets in the books of account. That is illegal. Then comes the tax avoidance. That falls between the tax planning and tax evasion, students. Tax avoidance meaning what? There are loopholes under the law. And I'm trying to use those loopholes, which will be as per the letter of the law. So my scheme, my transactions will be in line with the letter of the law, but not as per the spirit of the law. Not as per the spirit of the law. So basically, students, let's say for example, the law says income will be chargeable in the hands of the person who is earning the income. So what I'll do is, I will transfer my income to my spouse who does not have any income above the basic exemption limit. I will try to transfer the income to my child. This is a scheme of tax avoidance. I'm disclosing that it is their income. I'm not trying to evade the income. I'm disclosing. But it is their income. And that will result in lesser tax liability. The law doesn't say that you cannot transfer the income to somebody else. You can show that it is somebody else's income you receive in their bank account. And that is why we have a specific tax avoidance provision, SAR, specific anti-tax avoidance provision, to catch those loopholes, to curb those loopholes through which the tax avoidance is taking place. And that is why we have clubbing. So tax avoidance is legal. It is not illegal. It is falling within the letter of the law. It is against the spirit of the law, the purpose of the law. And that is why you have a clubbing provision as a specific anti-tax avoidance rule. Then we have general anti-avoidance rule, GAR, which is what we are going to do as a separate topic. Clear? So clubbing is not illegal. It is a tax avoidance tool, and clubbing is a specific anti-tax avoidance tool to curb that kind of tax avoidance of shifting the income in another person's hand. 194N is a TDS provision. See, that is not a specific anti-tax avoidance rule, Mansha. 194N TDS provision is to curb the cash transaction. Yes, there is one loophole. Assessee can withdraw from many banks. Limit is per bank. That is true. So there are loopholes under several other provisions of the law. For example, deemed dividend under 222A to 222E. So you are withdrawing the money from the company, but not in the form of taking the dividend. You are taking the loan from the company, and that is why you have 222E. It's a specific anti-avoidance regulation. Clear? Now, I was going to give you the note on reassessment. Those who asked me that when can the reassessment happen, even though the assessment has happened. So just go back to your assessment notes and just write it there. Besides this, under 147, reassessment can take place if assessment has already happened under section 143(3), but income chargeable to tax has escaped assessment. Has escaped assessment. Then you can write down the reassessment in that case should not be merely a change of opinion. That is, the reassessment should not be done only to should not be done by AO only to change his opinion formed earlier in the original assessment. It should be done only if it should be done only if the issue had not been examined or escaped the notice of AO earlier. Right? And the second case is if no assessment had taken place earlier. Okay. If no assessment had taken place earlier and time limit of assessment under 143(3) has expired. Fine. Okay, students. Now let's get back to the penalty topic. Now, in terms of this penalty under 270A, there are cases which are not included within the scope of underreported income. So you can just write down cases not included within the scope of underreported income. What are the cases which are not included within the scope of underreported income? Under section 270A. First one, where the assessee offers the explanation to the satisfaction of the AO. The assessee offers the explanation to the satisfaction of the authority. I'm not writing the AO because here this 270A can be initiated by AO, CIT appeal, PCIT or CIT. So if the assessee offers the explanation to the satisfaction of the AO and the AO is satisfied that the explanation is bona fide and all the material facts have been disclosed, then that will not be considered as underreported income. To the satisfaction of AO that the explanation is bona fide and all material facts are disclosed. Secondly, the amount of underreported income is determined on the basis of estimates. Underreported income is determined on the estimates. Is determined on the basis of estimates. So there are many, kind of businesses which exist, students, where the income is determined always on the basis of the estimates. For example, the retail traders, they do not maintain like proper transactions, the Kirana stores, they do not maintain the proper transactions in terms of the books of accounts, right? So in those cases, the income may be based on the estimates. The income may be based on the estimates. And therefore, in that situation, if the income is based on the estimates and if the accounts are correct and complete to the satisfaction of the AO, but the method employed by assessee is such that the income cannot be properly determined, then that cannot be considered as underreported. Income is determined on the basis of estimates, and if the accounts are correct and complete to the satisfaction of authority, but the method employed is such that income cannot properly be determined. Fine. So income in that case cannot be properly determined. Clear? Next is where the amount of underreported income is determined on the basis of estimate. And if the assessee has on his own estimated some disallowances and has included the disallowance in the return of income that he has filed, then in that case also that cannot be considered as underreported income. As underreported income is determined on estimates and assessee has computed the disallowances. So in that case also it cannot be considered as underreported income. Fourth, underreported income is due to the transfer pricing addition. Is due to the addition made by the transfer pricing officer. Is due to the transfer pricing addition. And the assessee has maintained the information and documents. The assessee has maintained the information and documents under section 92D. Declared the international transaction and disclosed all the material facts. Fine, students. So understand this particular important point. See, students, what happens is that in case of the transfer pricing, that day we were discussing about the SAP laboratories case, isn't it? That day we were discussing about the SAP laboratories case. In the SAP laboratories case, what did I tell you? Transfer pricing is a very fact-specific exercise. You have to find out the comparable companies, right? You have to find out the comparable companies. And then you have to apply certain filters. You have to take the method of transfer pricing into consideration to calculate the arm's length price. So see, it may happen that whatever method you may select to calculate the arm's length price may be very different from what the AO is selecting. It is also possible that you may select certain comparable companies to you, but the AO may select another set of comparable company. So normally there is a huge possibility of having the transfer pricing or arm's length price addition to your income. The arm's length price is computed by you may be different from the arm's length price as computed by the AO, because arm's length price is computed as per the methods which are prescribed in the chapter 10 that you will learn, and as per the methodology which is defined. Are we clear? So in that particular case, what happens is there could be huge chances of difference because it is a very, very fact-specific exercise. It's very subjective exercise. So if every time the ALP addition is made due to differences in the ALP computed by assessee as that of AO, then it will always result in the underreporting of income. So the Act says this will not be considered as underreporting of income because this is a subjective exercise. What may be ALP as per me may be very different from how the ALP is computed by AO. That is not the intention of the assessee to underreport the income. And therefore, it says that if you are maintaining the transfer pricing documentation, if you are declaring your international transaction, then this will not be considered as the underreporting of income. Are we clear? If you do not disclose the international transaction, students, then it will be considered as misreporting of income. Then it will be considered as misreporting of income. Failure to report any international transaction, deemed international transaction or specified domestic transaction, students. Namrata, the point 3 is underreported income is determined on the basis of estimates. And I have made certain disallowances. Let's say, for example, see, generally what happens, Namrata, there are certain expenses which you take it on estimate basis. For example, I am having a car, right? I am a chartered accountant. I am having a car. I am required to travel for my business purpose. I am having one car only in my house. So now this car, I will also take it for the purposes of my personal travel. I'm going for vacation, I'm going somewhere else, I'll use this car. I'm going for client meetings, I will use this car. So now the petrol expenses, Namrata, how will I allocate as to what is personal, what is business expense? So this will be based on estimates, right? Now what I'll do is, I'll take generally an estimate that, okay, 50% of my travel is for client, 50% is my personal travel. So I will disallow 50% of the petrol expenses. So now that cannot be considered as the underreported income. If tomorrow the AO says, no, this should not be 50%, this should be 70% personal and 30% business. Because this was based on estimates and I myself, suo moto, did the disallowances. Are we clear, Namrata? Okay. Last point here. The last point over here is, in the case where income is, undisclosed income is on account of search operations. Undisclosed income is on account of search operations because in this case, penalty is leviable under section 271 AAB. Yes, students? In case the undisclosed income is on account of search operations, then we have already discussed the penalty under 271 AAB. Isn't it, students? 30%, 60%, right? So then it cannot come to again 270E. If the penalty is leviable under 271 AAB, you cannot levy the income penalty again under 270E. So if you remember this, we have already done this penalty under 271 AAB, penalty on account of the search operation, students. I'll take you there. We'll quickly recap that penalty. In the case of search, we have already done that. Yeah. Penalties in the case of search. If the undisclosed income is admitted during the course of search in the statement furnished and the assessee explains the manner in which income was derived, pays the taxes and discloses the income in the ROI before the due date of filing return of income or under the time limit under 148, then the penalty is 30%. In another case, it is 60%. And what is undisclosed income? Any income represented by money, bullion, jewelry, which is not recorded in the books of accounts, not disclosed to the income tax authorities before the search, or any income represented by any entry which is not recorded in the books of accounts or is found to be false. Are we clear? So in that case, the penalty is 30 and 60%. Are we clear, students? So this is about section 270A. Now, in terms of section 270A, few other important points. So first of all, in case of 270A, the CBDT has power to relax the provisions of the levy of 270. So under 119, students, under section 119 of the Income Tax Act, CBDT has been given certain powers. CBDT is the authority which is managing the entire administration of the Income Tax Act. Under Section 119 of the Income Tax Act, it has been given the powers to issue the orders, instructions, and directions to the subordinate income tax authorities for the administration of the Act. And CBDT can issue these orders or instructions as to how the particular provisions are to be interpreted, how the assessments should be done, how the penalty proceedings should be conducted. Also, the CBDT has power to relax the provisions of the Act for the assessee. For example, in case you are not able to file the return under 139.1, under 139.5 belated, and even under 139.8. Let's say you are not able to file the return. Say you are not able to file the return, you have not filed under 139.1. You also miss the time limit of 139.5, 31st December, belated return. And you are not eligible to file updated return because you do not have the, or your case is that of a loss income. Your case is that of a loss. It's not of income. The loss is not getting converted to income, because if it's a case of loss, you cannot file updated return unless you convert the loss to the income. So you are unable to file the updated return. So you can go to the CBDT and ask for condonation of the delay in filing the return of income. You can request CBDT to grant you the opportunity to file the return of income. And then you can. So CBDT has power to relax certain provision in regard to the return of income, with regard to the scrutiny assessments, which could be 143, 144 best judgment, reassessment 147, time limit for filing the return in response to 148, rectification under 154, 155, deletion of interest on non-deduction of TDS or TCS by treating your assessee as default, advance tax payments or installment, interest under 234 ABC, or TDS, TCS late filing. For that also they can grant you the condonation. Penalty for underreporting and misreporting of income. So CBDT has power to relax these provisions. Number one. Number two is the penalty order which is there can be appealed to the ICAI if it is passed by the Commissioner Appeals or JCIT appeal, or by the Principal Commissioner or Commissioner under 263. If the revision is done, at that time the penalty is passed. So you can directly appeal to the ICAI. Because if it's a revision order under 263, you cannot go to the CIT appeal. Are we clear? Yes or no? Any questions, any doubts, students, till now? Okay. Now there are certain other penalties that we are going to discuss. There are certain other penalties that we are going to discuss, students. So let's discuss one by one. What are the other penal provisions? Now there is penalty in respect of the undisclosed income, students. In respect of the undisclosed income. Do you remember we have done the undisclosed income under 68, 69? Under which chapter did we do that? Students, undisclosed income under 68, 69. We have already done that. Yes or no? Under the set off and carry forward of losses, students. We have done the undisclosed income. 68, 69, what was that? Yes, students, faster. We have done that already in detail. And we have also done the penalty also for that. 68 and 69. Yes, students, faster. What is 68, 69 section? Undisclosed income. Yes, students. Faster. What is section 68, 69, 69A, B, C, D? Anyone? Yes, Mansha. Very good. Not in the first chapter, we did it with the set off and carry forward of losses. Mansha, you don't need to remember these sections which requires AO approval. You just need to understand the concept. And then it will be much clear. You don't need to remember, okay, here it requires AO approval. Once you remember that the concept, and then you will be able to recollect that, okay, this may require the higher authority approval. Underreporting of investment. Yes, Namrata. So we have done this chapter 68, 69 sections undisclosed income while we were dealing with the set off and carry forward of the losses, students. So section 68 is the cash credits. 68 says where any sum is found which is credited in the books of accounts for which assessee is unable to offer any explanation about the nature and the source. About the nature or source. So assessee is unable to explain to the AO the nature and the source. The sum so credited to the books of accounts will be considered as the cash credits. Now this happens even in the search cases. When the AO will find out after inspecting the books of accounts under the search that there are certain credits for which assessee is unable to explain the nature and source. He will make the addition under 68 as the cash credit. Or if it is a case of loan or borrowing. So any sum credited or in respect of loan or borrowing. The assessee is unable to explain that the sum which is credited as a loan or borrowing, the person in whose name such credit is recorded also offers that explanation about the nature and source. So basically, in respect of loan or borrowing, the explanation which is offered by the assessee will not be deemed to be satisfactory explanation unless the person from whom the loan is taken, basically the lender, is able to explain the nature and source of how he has given this amount to this person. Because the lender also should be in a capacity to lend. Let's say, for example, if I'm taking loan from my sister or my brother who is not earning anything and I've taken the loan. So unless my brother or sister sibling explains the nature and source of it, as to how they derive this particular money that they are able to give me if they do not have income, this would be considered as the cash credit. Or in respect of a closely held company. So this is unexplained credit. This is unexplained loan or borrowing. And the last one is unexplained share capital or premium. So in respect of closely held company, the closely held company is unable to explain the share capital as well as the resident shareholder who has subscribed to that share capital is unable to explain the nature and the source of the share capital invested. Are we clear? So in that case, it will be considered as the cash credit. Are we clear? Then section 69, where the investments are not recorded in the books of accounts, and the assessee is unable to prove the nature and the source of investments. Investments are not recorded. Again, this can happen in search. In such cases, they may find out that you have investments in several companies, but these are not recorded in the books of account. What is the nature and source of it? Means you had certain income which you have not disclosed. Unexplained money, where the assessee is found to be the owner of money, bullion, jewelry, and other valuable article, and the same is not recorded in the books of account, and the assessee is unable to explain the nature and source. Are we clear? Or investments not disclosed fully in the books of accounts, where the assessee is found to be the owner of money, bullion, jewelry, or investments, and the amount which is recorded in the books of accounts is lesser than the amount which is spent, and the assessee is unable to explain the difference. Or unexplained expenditure, the assessee is unable to explain the expenditure. Let's say, for example, if you remember, under the survey, the income tax authority has the power to ask about the details of the expenditure on any event, on any wedding, on any function which has taken place, looking at the amount of expenditure incurred. And if the assessee is unable to explain that, that can result in 69C. Are we clear? So what is the tax in these cases? It is 60% under 115 BBE plus surcharge of 25% plus cess of 4% resulting in 78%. Plus here no expenditure would be allowed, no loss set off is allowed, no basic exemption is allowed. So no set off of loss against the unexplained income. No set off of loss plus the expenditure or the basic exemption limit is not allowed. Are we clear? And then there will be penalty under 271 AAC at the rate of 10% on the tax under 115 BBE. Under 115 BBE. So if the income is voluntarily disclosed in the return of income filed under 139, plus the taxes are paid under 115 BBE, then no penalty under 271 AAC. And if it is found by the AO, otherwise then through the search, because if it is found during the search, then you will have penalty under 271 AAB. Are we clear? Then only there will be penalty is under 271 AAC. So if the assessing officer finds you during the assessment, then penalty under 271 AAC. If he finds it during the survey, during the search, then it is under 271 AAB. And if the assessee voluntarily disclosed, then no penalty. Clear? Vivad Se Vishwas scheme on Mansha was for a limited time period. Now it is not available. Are we clear? Okay. So this is the penalty which is there under 271 AAC, which is what, as I told you, I've already done that. So you can just come back to the assessment procedure under the search cases. You can just write down over here. Here you can write down undisclosed income under section 68 to 69D can be considered. And then tax at the rate of 78%. Clear? You can just write it over here like this. Now, what are the other penalties that we have to discuss, that we are required to discuss? So, rest of the penalties are very small penalties. So, just write down. First one, you can divide it, the penalty topic like this now. Again, most of it we would have already done, but you can just write over here. You can just write here penalty on undisclosed income, section 271 AAC, refer set of chapter. Here you can write refer search. Other penalties. First is penalty for failure to keep or maintain or retain the books of accounts under 44AA. Do you remember we have done this penalty as well? Maintenance of the books of accounts. If you remember, we have done this penalty already. Maintenance of the books of accounts under 271A. The penalty is 25,000. So if you remember, we have done this penalty for maintenance of books of accounts, non-maintenance, of books of accounts, where you do not keep or maintain the books of accounts as required under 44AA. So if, let's say, for example, you're required to maintain the books of accounts for profession, for the notified professionals, there are certain books of accounts. What are the limit? In case your gross receipts exceed rupees 1.5 lakh for the notified professionals. Then in case of individual or HUF, income from business or profession more than rupees 2.5 lakh, or sales turnover or gross receipts more than rupees 10 lakhs. Then in case of others, the income from the business or profession exceeds rupees 1.2 lakh and sales exceeds rupees 10 lakh. So in this case, you are required to maintain the books of accounts, or you report the income lower than the presumptive income, or section 44AD4 is applicable plus total income exceeds basic exemption limit. Meaning you are going under 44AD and then you are opting out within the 5-year period and the total income exceeds basic exemption limit. You are required to maintain the books of accounts. In case of notified professionals, 1.5 lakh, gross receipts exceeding 1.5 lakh. In case of others, individual or HUF, the gross receipts exceeding 10 lakh or the business income exceeding 2.5 lakh. In case of other than individual HUF, income more than rupees, income from business more than rupees 1.2 lakh and the gross receipts more than 10 lakhs. Then in that case, you are required to maintain books of accounts, and you are not maintaining, then the penalty is 25,000. The penalty is 25,000. Now this penalty is in addition to the penalty under 270A. So you can just write down, this is in addition to penalty under section 270A. Meaning it doesn't mean that if you have the penalty for underreporting or misreporting of income, you will not have penalty under 271A. You still can have the penalty under 271A. The underreporting or misreporting of income penalty 270A will only not apply in search cases. Other than that, these penalties will be in addition to the penalty under 271A. Are we clear? Then failure to keep and maintain the information and documents of transfer pricing that you will learn in the transfer pricing class, which is 2% of the value of international transaction. And there are several penalties there. In case, let's say, for example, you fail to furnish the information to the income tax officers which are required under the transfer pricing, then it is 5,000. So you will then learn in the transfer pricing class separately. Are we clear? So that you are going to learn in the transfer pricing class. Then next penalty is, come back to penalties topic. Penalty for false entry. Penalty for false entry in the books of accounts or omission of any entry penalty for false entry or omission of entry to evade the tax liability. To evade the tax liability. So false entry means false entry includes use or intention to use the forged documents or falsified documents, forged or falsified documents like false invoice, then invoice without receiving the goods or services, invoice without the actual supply of goods or services, invoice from person who does not exist. Who does not exist. Then the penalty will be equal to amount of the false or omitted entry. The penalty shall be equal to the amount of false or the omitted entry. So this penalty is leviable on the person who is making this false entry and also on any other person who is enabling this false entry. So you can write down penalty leviable on person making false entry and on person who is enabling the person to make the false entry. So who is supplying the false invoices. Okay. So this is the penalty under section 271 AAD. This is under 271 AAD. Now you will ask, ma'am, there is also misreporting of income under 270A. And then you are saying there is this penalty under 271 AAD. So which penalty will apply? So this can apply in case of false entry because this is a specific penalty which is there. This is a specific penalty which is there. So this will particularly apply in case there's a false entry. So you can just go back and write it over here where we had written about the false entry under the misreporting of income. Recording of false entry in the books of accounts. You can write here penalty under section 271 AAD. there can be penalty under section 271 AAD. Are you getting that? Yes or no? So this is for the false penalty. Now students, there can also be the prosecution under 276C. There can also be the prosecution, students, in this particular case. Now what can be the prosecution over here? So see, we are covering everything together. So there is a prosecution which says that if there is a willful attempt to evade the tax, penalty or interest, and if the evaded tax on the underreported income exceeds rupees 25 lakh, then there will be prosecution of 6 months to 7 years. Otherwise, it can be 3 months to 2 years. Are we clear? So just write down. In case of underreporting of income and these kind of offenses where the tax is to be evaded, so prosecution under section 276C prosecution under 276C, which says willful attempt to evade tax, interest or the penalty. So if my evaded tax or if the evaded amount, you can just write greater than rupees 25 lakh, then it shall be 6 months to 7 years plus fine. And if evaded amount is less than rupees 25 lakh, then it shall be 3 months to 2 years plus fine. So I can have the imprisonment in these cases. Second prosecution is prosecution under 277A. Falsification of books of accounts or inducing any person to evade the taxes. Then in that case, falsification of books of accounts or inducing any person to evade the taxes, which is the penalty is levied under 271 AAD. In that case, there can be imprisonment of 3 years, 3 months to 2 years plus fine. So here there can be imprisonment plus fine. Yes, students, is it clear? Yes, if consultant gives false invoice, then he will also liable be under 271 AAD, Namrata. That's correct. Yes or no, students? Okay. Now, what is the next penalty that we have to deal with? So, the next penalty is about the 271 AAE, which is if during any proceeding it is found that any person which is the charitable trust or institution registered under 11, 12 or 1023C is applying the income for the benefit of any another person. So this is also the penalty that we have done already, students. Under charitable trust, if you apply the income of the charitable trust for the benefit of any other, for the benefit of a specified person under section 13, students, then in that case there is a penalty under 271 AAE, students, isn't it? Taxation of trust. Do you remember that? In that we have done that. So there is a penalty under 271 AAE, which is 100% of the amount of income which is applied, and 200% if the offense is repeated. 200% if the offense is repeated. Are we clear? So that is something which results in the penalty under 271 AE. I'll just take you there. So income of the trust for the benefit of any other specified person, penalty under 271 AE. 100% in case of first time, 200% in case of subsequent offense. And then there will be tax under 115 BBI at the rate of 30%. Plus, income will not be eligible under levy. Are we clear? Then, failure to get the books of accounts audited under 44 AB, students. Failure to get the books of accounts audited under 44 AB. What is the penalty in that particular case? So in case you do not get the books of accounts audited, if your business has cash receipts, cash payments less than 5% of total receipts, total payments, then the limit is 10 crores. Otherwise, the limit is 1 crore. Or if you are not getting your books of accounts, if you are offering the income less than presumptive of, or your business is under 44AD and your 4484 and is applicable and total income exceeds the basic exemption limit, then the penalty is, in case you are not auditing, penalty is under 271B, lower of 0.5% of total receipts or turnover or sales or rupees 1.5 lakh, whichever is less. Is it clear? So in this case, there will be the additional penalty which will be levied. Then students, we have the penalties in relation to the TDS and TCS. We have penalties in relation to the TDS and TCS. So just write down. I don't know if you have done that already in the TDS classes. So you can just write here. Just write down. Penalty in relation to TDS, TCS. So failure to deduct tax or pay tax. Failure to deduct the TDS, or this is the amendment, failure to pay the TDS. So earlier there was no penalty on non-payment of TDS, but now there is failure to deduct the TDS or failure to pay the TDS under section 194B, which is winning from lottery or crossword puzzle. 194R, which is in respect of the perquisites, and 194S, which is for the virtual digital asset, which is for the virtual digital asset, or in the case of 194BA. So only in these cases, when you fail to pay the TDS, if you fail to pay, let's say the TDS under 194C, there is no penalty. When you fail to pay the TDS for these particular provisions, you can just write like this otherwise, so that you remember. Failure to pay the TDS under section 194B, under section 194R, under section 194S, which is on virtual digital asset, and 194BA, winnings from online gaming. If failure to pay any other TDS, no penalty. So failure to deduct TDS, it can be any TDS section. But for failure to pay TDS, these should be only in these four situations. Only in these four situations. Okay? So in all the four situations, then in that case, the penalty shall be 100% of the amount of tax which the assessee has failed to pay or deduct. 100% of TDS. This is under 271C. This is under 271C. Next is failure to collect the TCS. Failure to collect the TCS. Then in that particular case, the amount of TCS. Penalty shall be TCS. Okay. Under section 271CA. Then the other penalty which is there is in case of the TDS and TCS. In case of TDS and TCS, there will also be prosecution under 276B and 276BB. So there can also be prosecution in these cases. The prosecution under section 276B and prosecution under 276BB. So in these cases, the prosecution which can be initiated for failure to pay or failure to deduct the TDS. So failure to pay the TCS or failure to deduct the TDS or pay under these sections can result in prosecution of 3 months to 7 years plus fine. Are we clear? Next, in respect of the TDS TCS is failure to furnish the TDS or TCS statements or failure to furnish the or in furnishing of incorrect statements. So failure to furnish TDS or TCS statements or furnishing the incorrect statements. or furnishing the incorrect statements. So in case you fail to furnish the TDS TCS statements, there is a fees under 234E of 200 rupees per day, isn't it? You have the fees also. Plus there can be a penalty initiated as well. Plus there can be the penalty initiated as well. Now what is the penalty for TDS TCS failure? So in that case, it is 10,000 to 1 lakh rupees. So 10,000 to 1 lakh. This is the penalty. If you fail to furnish or furnish the inaccurate statements. The next one which is there is the failure to obtain the TAN application. Failure to obtain the TAN application or failure to deliver the declarations which are required under the TDS TCS or failure to deduct and pay the tax. Right? So in that case also there will be penalty. So just write down failure to comply with the TAN. Failure to furnish, failure to apply the TAN. 10,000. This is under section 271H, okay? Failure obtain TAN, it is 10,000. This is 272 BB. 272 BB. Then finally the last one is the failure to furnish incorrect information under form 15CA. So under 195, you have to file form 15CA, 15CB. So then in that particular case, you will have failure to furnish information or furnishing inaccurate information under section 195(6) form 15CA. This is going to be rupees 1 lakh under section 271I. So these are all the penalties which are leviable with respect to the TDS or TCS. Are we clear? Then what are the other penalties? The other penalties are basically the furnishing of incorrect reports by the chartered accountants. So in case you are furnishing inaccurate audit reports by the CA. So in case you are furnishing the inaccurate reports by either the merchant valuer or registered valuer, merchant banker, any valuation reports which are required under the Act, any certificate which is required, this is rupees 10,000 per certificate. This is under section 271G. This is under section 271G. Then the rest of the penalties, students, we have already covered. For example, failure to furnish the statement of financial transactions, 500 per day, I had already told you. Or failure to furnish the SFT within that time period, then it is 1,000. Inaccurate SFTs, it is 50,000. Or if the inaccurate statement of financial transaction is because of the information which is not received properly, then it is 5,000. So all of that penalties we have already done at the relevant place, right? Then, for example, I have already told you about the failure to give responses to the notice under 142(1), 143(2), or when the research associations are not giving their statements or the donation receipts which they are required to give, or you're not giving the answers to the income tax authority, failure to comply with that, that results in penalty of 10,000. That also we have discussed elaborately. So all the other things we have covered at the relevant point of time. At relevant places, all other penalty. Or for example, failure to comply with the PAN provision, that also we have done, 10,000 is there. Failure to comply with Aadhaar, that also we have done. So every other penalty we have done. Now last penalties which are remaining are in respect of three particular sections. So that we are going to deal with as separately, because these are three different sections, which is 269 SS, 269 ST and 269T. Now, what are these particular sections? So see, these particular sections are on mode of taking or accepting certain loans, deposits and specified sum. And then what is else remaining is the immunity from penalty and then the black money law. So this is what we are going to deal in the next class. Not in this lecture, in the next class we are going to deal with that. But as I said, majority of the penalties we are done with already, students. Okay. Now I'll take up your questions. Misreporting or tax evasion attracts prosecution provision? Yes, Mansha, it does attract. Consultant is just giving advice and not false invoice, then in that case there will not be any penalty, Namrata. It depends on the facts. Mohan, we will start the new topic. I think from Wednesday onwards, you have the lectures on transfer pricing, so you can attend that. So that is something, the new topic. And then again, we'll be back with the penalties class once again after the transfer pricing gets over, student. Because right now we are just left with few penalty, which is only in respect of 269 SS, 269T and the black money law we'll start with. Any questions, students, you have before we close the session? Yes, students. Will you please revise this? Yes, students. Yes or no? Okay. So I'm hoping that you don't have any questions and I'll just close this session for today, and then we are meeting directly after your transfer pricing lectures get over. Okay, students. So thank you so much and we'll meet in the next class. Okay. We can close the session.